welcome to today's discussion on the newly launched Nippon India Nifty 500 Momentum 50 Index Fund. To break it down in detail, I'm pleased to have with me Arun Sundaresan, Head of ETF at Nippon India Mutual Fund, and Sneha Suri, Lead Fund Analyst at Value Research. Welcome both of you.
Hi, Ruchira. Happy to be on the show.
Thank you.
Arun, let me come to you first. Could you start by giving us an overview of what the Nifty 500 Momentum 50 Index Fund is all about, and how is this different from other momentum-based funds out there?
So traditional investing generally is about buying stocks or any investment at a lower price. So you buy low with the hope that it will appreciate and you'll be able to sell high. So that's the traditional approach. Contrary to this, against this approach, the momentum style of investing is very different. You try and identify stocks which are already doing well. Probably they're already pricey or they are high, with the hope that it will go even higher. So you buy high and sell even higher. That's the concept of momentum. It may be counterintuitive, but as I'll explain, it had worked in many circumstances and generated phenomenal returns over a period of time. So the Nippon India Nifty 500 Momentum 50 Index Fund, the name suggests, is an index format where we'll be replicating this particular index. So the universe is Nifty 500. So on the entire market, the momentum factor will be applied and 50 stocks will be picked up based on that. So that's the concept of this particular fund.
And if you could also explain how is it, any different from the similar momentum-based funds that are already out there?
Sure. So this is not entirely first of its kind. There is another strategy which is currently on as well. But as of now, there are a few strategies in the market which is on the 200, Nifty 200. So that's one strategy. There are also a couple of strategies on the mid-cap 150. So both of them focus on a particular part of the market, whereas this will invest across the entire 500, Nifty 500, which means that across large, mid, and small cap, regardless of which parts of the market you apply the momentum, and wherever momentum is working, it gets picked up. So that's how this is different from the existing momentum strategies.
Right. Sneha, from your perspective, how does the Momentum 50 Index stack up against other strategies? Also, what makes it stand out from an analyst's point of view, if you could explain that?
Sure. So broadly, as Arun mentioned, this index picks stocks which have been appreciating sharply over a short period, that is, are experiencing that momentum, a strong price trend. So this strategy benefits from the strong get stronger principle, where stocks with upward price trends tend to continue performing well in the near term. This is due to that focus on price trends, rather than the conventional driven stock picking, like Arun mentioned. Of course, some checks and balances are built into the process of these strategies, since they pick stocks from their bigger parent indices, the Nifty 500 being the one for this particular fund. Talking about other factor-based strategy indices that we have, they also select stocks from a particular index based on different rules. So we have value-based funds, quality-based funds, etc. So different funds use these factors differently. Some of them use them in isolation, that is, basing a fund on one factor, or let's say in combination to create a unique basket of stocks. So notably, each factor has its moment in the spotlight, and dominance mostly rotates over time. While momentum can deliver dramatic returns, it's also subject to a higher volatility in the short term, and that can be seen in its back-tested data of minimum 1-year rolling returns, which stands at a negative 60%. And of course, like Arun mentioned, currently there are no established funds tracking the Nifty 500 Momentum 50 Index, with only 2 funds in their NFO period, including the one from Nippon India that we're discussing. But, based on the funds tracking the Nifty 200 Momentum 30 Index, it is fair to say that so far the returns have been appealing, but the strategy is actually yet to see any major bearish phases, since these funds have only been around since 2021. But the funds have so far been tracking the index relatively well.
Right. Arun, if you could explain what is the selection process like? How do you go about selecting top 50 stocks from the broader Nifty 500 universe?
So the definition of momentum is actually price momentum. So the last 6 months and 1 year price returns are considered, but not just only the price. The price is adjusted for volatility. The price is divided by the standard deviation, so to say, and this number is called as momentum ratio. So that's primarily used for picking up stocks. Of course, there are, like what Sneha mentioned, there are finer details. We eliminate a few stocks based on certain parameters, like if it is low on volume and the promoter pledges on the higher side, etc., to ensure that the universe and eventually the number of stocks we select are investable. So that's broadly the method. By end of the day, what it does is it purely goes by the past return. It does not look into factors like quality factors like what has been the return on earnings or even valuation metrics like what is the PE, PB, etc. It goes simply by what is done well. Having said that, while this may give an impression that this goes only by price and therefore it may pick up fundamentally weak companies, but the end result, because you're picking up something which is doing well, and those stocks could actually be doing well for fundamentally strong reasons. So you can't say that the momentum strategy does not pick up fundamentally good companies. It can so happen that the portfolio could be relatively strong.
Right. And how often is the index rebalanced? And also, if you could walk us through how that rebalancing affects the overall portfolio.
Sure. So the index is rebalanced twice, once in June and once in December. I did mention to you about the methodology where to start with the momentum scores are considered. That's how the 50 stocks are picked up. But once it's picked up, the weighting is actually done basis the free float market cap. So we call this tilt weighting methodology. In simple words, to say that suppose a big stock has a certain momentum and a small cap stock also has equal momentum, the bigger stock will get a higher weight because it is having a higher free float. So you will have to see this in relation to where the market is, Nifty 500, and in relation to it, the different parts of the market, where you have higher momentum. That's what gets picked up. So we've seen data while Sneha mentioned that some of the existing strategies are available only from 21. The index itself, the data is available way back from 2005. So we have almost 19 years of data, and we've seen how the index, the strategy based on backtested results, how this is done over different points in time and different parts of the, different market times and the average returns, the volatility, and so on and so forth. This seems to be having a relatively strong risk return profile.
Okay, you mentioned that it seems to have a very strong risk return profile, but markets are cyclical and momentum can shift quickly. So how does the fund prepare for or manage the risks of rapid changes in momentum?
So one is this rebalancing frequency itself, the 6 months and every 6 month rebalancing, right? And you also asked this question, how it impacts the portfolio. In fact, it seems to have impacted positively in the sense that because there is a frequent change, it's very quick to react in terms of what is working, and the portfolio undergoes significant change to reflect the changing momentum. So that's a positive thing. It doesn't stick on to the same portfolio for very long. What works, regardless of market cap, regardless of the sectors and themes that the various stocks could be operating in, it picks up. So it's been fairly dynamic, and it seemed to have worked in different market conditions. Yes.
All right. And do you think momentum investing will hold up as a strong strategy in the Indian markets over the long term, or are there certain market conditions where it works best?
So generally, when you think about momentum, you tend to think that these are bull market products, and it may work only when markets are having the momentum, so to say. But the data actually suggests a completely different thing. I did mention that 19 years of data is available. So we looked at not just the current returns, the last 1 year or 3 year or 5 year return. So if you looked at the average rolling return, see, for example, the 3 year average return at any point in time, you invested in the last 19 years and you looked at the 3 year return. And what has been the average 3 year return? That's what we mean by the average 3 year rolling return. That number for this index is close to 20%. So just to give you a perspective, the equivalent number for Nifty 50 and Nifty 500 is 12.5%. So, and these are all CAGR. Okay, so what we are saying is there is almost a 7.5% difference when compared to Nifty 500. Even when compared to mid cap and small cap, which are generally considered to be more aggressive strategies. So mid cap is given close to about 15% over the 3 year average return. Small cap is given close to 13.5%, 14%. So we are talking about whether it is the Nifty 50, 500, mid cap, small cap. The strategy one has done phenomenally well. So in this case, we are talking about 3 year rolling return. Similar is the 5 year story as well. This is point number one. And the second interesting fact is more than 80% of the time, in fact, to be precise, 83% of the times, this has outperformed Nifty 500. So that's a big number. I'm sure you will appreciate that over the last 19 years, markets have gone through various phases. And for a strategy to outperform the broader markets in 83%, in fact, over 5 year rolling return, this number goes close to 100%. So while it might be perceived that it might work in certain market conditions, the data seem to suggest, obviously these are past data, but the data seems to suggest that the strategy has the potential to generate far more sustained returns. And we noticed even in difficult times, like for example, 2011, the markets fell by almost 26%. This actually fell lesser, which means that actually performed better than the market. Likewise, in 2013, 2019, 2020, all these were difficult years for the market. The strategy actually either performed in line or slightly better as well. So we may not be able to say that this may not work in bear markets. By and large, this seemed to have worked. But having said that, there will always be phases. For example, we noticed in 2008 and 9, which were obviously on hindsight extreme periods where markets corrected very, very sharply and then recovered also very sharply. During that period, this particular strategy underperformed because momentum could work on a lag. That something which fell very sharply, the allocations could be based on that. Then some other part of the market recovers faster. So this may lag. So those kind of things can happen. But by and large, they seem to have done very well over a longer period of time and fairly consistently.
All right, so Arun, who would you say this fund is best suited for?
So while this is a smart beta product, it's a strategy product, it's based on momentum style, but the underlying is fairly diversified. So we are going to invest in the entire market, 500. So we're talking about large, mid, small cap, wherever momentum is, it's going to pick up. And there are going to be 50 stocks. It's not, very 10 stock, 15 stock. It's 50 stock. And there is a capping applied to each stock. No single stock can be more than 5% at the time of rebalancing. So you have fair bit of diversification from that as well. While it does not start with sector, it's bottom up, from a stock picking perspective, but you will have exposure to multiple sectors. Currently, it has exposure to 13 sectors. So from all that sense, it's fairly diversified. And I explained to you based on, the past track record in terms of how it's worked in different market conditions. It gives an impression that this could be considered as an all-weather proposition. It can suit a whole lot of equity investors, where they're looking for a good strategy which can work for them in the longer term, generate potentially higher returns, and also has the possibility of generating that reasonably consistently. I think, this is one such strategy. So this may be suitable for a good number of equity investors who seek, aggressive risk return profile.
Right. Sneha, what's your take? How should investors think about using this fund as part of their broader investment strategy?
Right. So So, like Arun mentioned that, such stocks will do well in a runaway bull markets. And the back-tested data shows that they have done reasonably well in the bearish phases as well. But investors should look to consider these strategies when they've, these kind of stocks have seen bad times in real-time basis. Investors can treat such strategies as part of their supplementary allocation, say about 5 to 10% of their portfolio. That really won't keep them up at night. So the, fun allocation, as we say. Because again, mentioning the fact that much of its historical data is back calculated. So given the kind of untested nature over a full market cycle, conservative investors may choose to avoid momentum funds, but those open to, higher risks can embrace the ride.
Well, that wraps up our discussion. Thank you, Arun, and thank you, Sneha, for sharing valuable insights. It's been a great conversation. Thanks.
Thank you, Ruchira.